Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al next to me. Thanks for tuning in each and every Saturday. Talking retirement planning and more importantly, tax planning when it comes to the distributions from your overall retirement accounts. This is going to be big because there's more and more and more money going into these retirement accounts. And unfortunately, I really don't think that you really understand the true impact of the taxes. That's what we're going to get into the rest of the show. But before we do that, let's get to the true-false question.
If I am still working past age 70 and a half and I'm contributing to my company's 401k plan, I can delay the required minimum distribution until I retire. And the answer to that is true for that account, and that's the key, for that account. So here's how it goes. Typically with an IRA and a 401k, you need to start withdrawing money out of those accounts at age 70 and a half, but there is an exception. And the exception is if you're still working in a 401k plan, you can delay it until April 1st of the year following you retire. So that could be 75 years old, it could be 80 years old, and so forth. Now, in some cases, people actually have old 401ks. If their current plan allows it, you might even want to consider rolling that old plan back into the new 401k of the new employer, because then you won't have to take required distributions on that. So that can be a pretty good deal.
Yeah, when you take a look at the biggest beneficiary, I think, of these retirement accounts, Al, is the IRS.
Yes,
and,
of course.
And the biggest thing is that you really have to truly understand these accounts, because if you have, let's say, $1 million in your retirement account, you truly don't have $1 million because you are partners with the IRS. They are going to take their piece. And so the problem is this, is that more and more baby boomers are retiring. And here's a real quick example of a huge mistake that can blow you up very quickly, is that an individual just retired. They have a very large pension of about $100,000 plus their Social Security and everything else. They're making $150,000 total income. Great income. They don't spend a lot, so they had a ton of income. They had also accumulated $1 million in their retirement account. So think of that. How beautiful a retirement is that going to be, right? You got $150,000 income, $1 million in your 401k plan. Life is great until this happened. He had a $350,000 mortgage. Okay, so when they go into retirement, most people say, hey, I want to be debt-free. I have a $150,000 pension. I have $1 million sitting in this account. I'm going to take $350,000 out of my retirement account to pay off my mortgage, because that was his only liquid assets. They had about $10,000 or $20,000 sitting in cash, but the bulk of the liquid assets was all in the retirement account. So he takes $350,000 out of his retirement account, pays off the mortgage. Now he feels, hey, I have $150,000 income. I just paid off my mortgage. This is going to be the best retirement ever until April 15th of next year. Because do the math. You got $150,000 of income. Then he took out another $350,000. So that's $500,000 total income. Al, what do you think the tax would be on that? $500,000.
Yeah, probably federal and state, a couple $100,000.
Another $200,000 of tax. Where does he have to go to pay the tax? You guessed it, back to the retirement account. Another $200,000 out of the retirement account to pay the tax. Wait a minute, now that's $350,000 of income the following year. Now he owes another $100,000 of tax. Where does he have to go to pay the tax? You guessed it, back to the retirement account. Let's pull out another $100,000. It's tax upon tax upon tax. It will blow people up. That's why we're so passionate about talking to you about you've got to find a way to diffuse this. There's also a ton of penalties. If I'm taking money out the wrong way, the IRS is not going to be the biggest beneficiary, but there could be penalties if you don't understand the rules. Yeah. So let's take a look at some of these penalties.
Yeah, and I guess the first one really is if you take it out early withdrawal penalty before 59 and a half on an IRA or 55 on a 401k when you're retired, there's a 10% penalty. A lot of us know about this and realize the 10% penalty is just the penalty part. You also pay income taxes on top of that. If you make too much of an IRA contribution or 401k contribution, it's an excise tax of 6%. And then the big one is if you forget to take your required distribution at age 70 and a half, they charge you a 50% penalty. Can you imagine a 50% penalty? So let's say you're supposed to take a $50,000 required distribution and you forget to do it. So your penalty is $25,000 plus you got to take that distribution. So be careful of that one.
So Al, why don't you go over to the whiteboard and let's talk about some strategies, because there's a new tax law that just came out, and I'm telling you that this is going to be one of the biggest things ever, is that it's going to help you basically build a tax-free income. If you have after-tax contributions inside your 401k plan, I'm telling you, this is going to be very, very important that you understand this new tax law. I'm telling you, it came out about a month ago. So if anyone that is watching this program that has after-tax dollars, pay attention, because Big Al is going to show you how you can save tens, if not hundreds of thousands of dollars long-term inside your retirement accounts.
All right, so this is brand new, just about 2, 3, 4 weeks ago. And this is for what happened with the old law. You had a 401k, okay? And the IRS said you can roll that 401k to an IRA. And a lot of people do that. Roll that to an IRA, so that's not a bad idea. Why would you do that? Well, if it's in an IRA, you're going to have more investment choices. You have more control over it. We did a whole other show as to why you might not want to do it, but many people want to roll that out. Well, let's say you have $100,000 in here, and $10,000 is post-tax, meaning you put money in where you didn't get a tax deduction. And so you're allowed to roll that out, but now it's the same character in the IRA. $10,000 is post-tax. Let's say you have a $100,000 account, so 10% is post-tax, which means when you withdraw, 10% of the amount will be tax-free. So that's not too bad, but now there's a much better way. Here, watch this. With this new law, your 401k, this is what you can do. You can take the post-tax one, and now you can put that into a Roth IRA. Now that's $10,000 going into a Roth IRA. Why is that important? Now all future growth on that $10,000 is 100% tax-free. You don't have to take a required distribution out of this. You can let it grow as long as you want. Now the other $90,000 that's still in, you can roll that to an IRA. No problem there. But now you have control. You can take a distribution from your IRA, you pay tax on that. You can take it from the Roth and you don't pay tax on that. You have control, and all future growth is tax-free here in this Roth. It's not the case here. You're just stuck with that original $10,000. For those of you that have post-tax dollars in your 401k, this is gigantic. You want to take advantage of this. It's a big deal.
Yeah, any employee that has a 401a or any type of plan that is post-tax, you want to make sure that you maximize that. So there's different employers around San Diego, Orange County, LA, that they have a post-tax plan where you don't get the tax deduction going in. It grows 100% tax deferred. But here's the big deal, is that before it was like commingled, right? It was hard to separate it. It was like taking a cup of coffee and putting cream in it and then trying to separate the cream from the coffee. Unless you're a scientist, it's pretty hard to do that. Now, the law states that you can segregate the accounts and then have that money grow tax-free for you directly into a Roth IRA. If you have a post-tax plan, call the number right now, get into our office for a free retirement assessment. We will help you understand the tax code, what's available to you, and then we can help you achieve financial freedom. So call the number. It's 888-994-6257. It should be right below me, but it's not. So I'm going to continue. There we go. And then we're going to continue to talk about the number. 888-994-6257.
Hi, I'm Mike Bernier with Pure Financial Advisors. And did you know that 250,000 Americans are retiring every month? And of those Americans, the average retirement account size is $25,000 to $100,000?